The emotional adamancy which dominates most analysis of gold contributes to confusion and misunderstanding. For example, backdrop for gold today is as bullish as it has been in a long time, or precious metal sector is on major buy signal. These and other similar claims are often supported by reams of technical analysis, the best that money can buy. And this is on top of general misstatements of fact. It would appear that there is virtually no justification for lower gold prices except when caused by manipulation associated with conspiratorial forces. Otherwise, world tension, terrorism, natural calamities, social unrest, economic weakness, interest rates, inflation, trade deficits, Indian jewelry demand, etc., all put a floor under the price of gold. At least this is what we are told. And the timing. Oh, my word, the timing. It's now or never. Gold has finally broken through its overhead resistance. $2,000 per ounce by the end of 2017. Does understanding gold require a degree in cyclical theory or financial mathematics? Or is it related to climate change? A simpler and better explanation for gold exists. It only requires a bit of historical observation. One, first and foremost, is the simple fact that gold is real money. Its value, purchasing power, is constant and stable. And its role as money came about through trial and error. Gold has stood the test of time. 2. Second, paper currencies are substitutes for real money. Gold is also original money. It was stored in warehouses and the owners were issued receipts which reflected ownership and title to the gold on deposit. The receipts were bearer instruments that were negotiable for trade and exchange. 3. Third, inflation is caused by government. One thing that should be clear from history is that governments destroy money. That might sound harsh, but it is true. And when we say destroy, we mean just that. Inflation is practiced intentionally by governments and central banks. Its effects are severe and unpredictable. The Federal Reserve Bank of the United States has managed to destroy the US dollar by bits and pieces over the past century. The result is a dollar that is worth 98% less than in 1913 when the Fed began its grand experiment. The relationship between gold and the US dollar is similar to that between bonds and interest rates. Bonds and interest rates move inversely. So do gold and the US dollar. If you own bonds, then you know that if interest rates are rising, the value of your bonds is declining. And, conversely, if interest rates are declining, the value of your bonds is rising. One does not cause the other. Either result is the actual inverse of the other. A stable, or strengthening US dollar means lower gold prices. A declining US dollar means higher gold prices. In other words, higher gold prices are a direct reflection of a weakening US dollar. And please don't confuse the US dollar with the US dollar index. The US dollar index (S) do not tell us anything about the price of gold. A dollar index reflects changes in the US dollar's exchange rate versus other currencies. Actual changes in the value of the US dollar show up in the ever-increasing general level of prices for all goods and services over time. The threat of world war is ominously present today. Countries and municipalities are going bankrupt. And acts of terrorism are an almost daily occurrence. This is in addition to an economy that can't seem to improve enough or sustain an acceptable rate of growth. So let's buy gold, right? Maybe, maybe not. You see, gold doesn't care about those things. It doesn't care whether or not somebody fires a rocket armed with a nuclear warhead or the state of Illinois declares bankruptcy. And it doesn't react to comments by Janet Yellen or Donald Trump. Indian jewelry demand is not on its radar. Nor are housing starts. Gold responds to one thing. Changes in the US dollar. Nothing else. A continually weaker dollar over time means higher gold prices. Periods of dollar strength are reflected in a declining gold price. Let's talk for a moment about North Korea and the threat of war. It's a very scary situation. But even if things get worse, it won't have an impact on gold prices. Here's why. In late 1990, there was a good deal of speculation regarding the potential effects on gold of the impending Gulf War. There were some spurts upward in price and the anxiety increased as the target date for action grew near. Almost simultaneously with the onset of bombing by US forces, gold backed off sharply, giving up its formerly accumulated price gains and actually moving lower. Most observers describe this turnabout as somewhat of a surprise. They attribute it to the quick and decisive action of our forces and the results achieved. That is a convenient explanation but not necessarily an accurate one. What mattered most for gold was the war's impact on the value of the US dollar. Even a prolonged involvement would not necessarily have undermined the relative strength of the US dollar. All of which leads us back to a simpler and better explanation. Insofar as gold is concerned, it's all about the US dollar. Kelsey Williams is a retired financial professional living in southern Utah. His website, Kelsey's Gold Facts http://www.kelseywilliamsgold.com, contains self-authored articles written for the purpose of informing and educating others about gold within an historical context. In addition to gold, Kelsey writes about inflation, interest rates, and the Federal Reserve Bank. His articles have been published on several international websites.